Welcome to the deep dive. Today, we are digging into something that I think is, well, it's the ultimate goal for a lot of us.
Financial liberty.
Exactly. We're going to try and take this big abstract idea of buying back your time and turn it into a concrete, measurable project.
A real roadmap. That's the mission. All the sources we've looked at, they all point to one thing. Success comes from preparation.
Right. You can't just wing it.
You can't. It's like trying to climb a mountain by just, looking up and starting to walk. It doesn't work.
So today is about replacing that hopeful guesswork with actual numbers. We need a target. There's that great line, if you don't know where you're going.
You won't get anywhere. So we're setting a real trajectory.
And that trajectory, it really depends on your timeline, doesn't it?
It does. A short-term goal, say, a trip next year that needs liquidity, low risk. Medium term, like a house deposit, maybe a bit more growth.
But for us, today we're focused on the big one.
The long term. Financial independence. That means aiming for high returns and accepting that it takes time. And yes, it comes with significant risk.
Okay, so let's start at the very beginning. The one step that I think everyone dreads.
The budget.
The budget. Before you can even think about investing, you have to know what's going on right now. I love that John C. Maxwell quote.
Oh, it's perfect. A budget is telling your money where to go instead of wondering where it went.
It's about control, not restriction.
Exactly. And to get that control, you need clarity on two types of expenses. First, the easy ones.
The monthly expenses.
Your rent, food, transport, all those subscriptions that just, add up. Phone bills, internet, all of it.
And a really practical tip from the research is don't kill yourself trying to be perfect.
Yeah.
Just use the average of the last 3 months. Your banking app probably already categorizes most of it for you anyway.
It does the heavy lifting for you. But then there's the second category, the silent killer.
Annual expenses.
Yes. The ones you forget about until the bill arrives
Yeah.
and just destroys your savings for that month.
Things like property tax or your annual car insurance renewal.
Or car repairs, holiday gifts, things that don't happen every month, but they definitely happen every year.
The best advice we saw was to try and smooth those out. Break them down and set aside a little bit each month.
A twelfth of the cost every month. It makes a huge difference. Let's make this real with the example we found. Sandra.
Right. So Sandra, she hated spreadsheets, but she sat down and did the work.
She did. She listed all her monthly costs, rent, food, everything, and then she tallied up all those irregular annual expenses.
And what was her final number?
Her total annual expenses came out to 19,200 euros.
Okay, so 19,200, that is the magic number. That's the amount of income her investments need to generate every single year so she doesn't have to work.
That's the value of her freedom.
So how do you get from that number to the actual target, the total amount of capital she needs?
This is the pivotal step. You take that annual expense figure, the 19,200, and you multiply it by the magic multiplier.
Which is 25.
25.
So 19,200 times 25 gives you, wow, 480,000 euros.
480,000 euros.
That's a serious number.
Yeah.
So why 25? Where does that multiplier come from? It feels a little arbitrary.
It's not arbitrary at all. It's actually the inverse of a very famous rule in retirement planning.
The 4% withdrawal rate.
Exactly. The idea is if you have 25 times your expenses invested, you can pull out 4% of that each year to live on. And in theory, the principal should last, well, pretty much indefinitely.
That sounds almost too simple, too good to be true. I mean, it completely depends on the market giving you returns that are higher than 4% over the long run.
It does. But we have some incredibly robust academic data on that. One study looked at over 220 years of U.S. stock data.
2 centuries.
And found that U.S. stocks gave a real average annual return, so after inflation, of almost 7%. That long-term history is what gives us confidence in these models.
Okay, so the returns are there historically. But is that 4% withdrawal rate actually, sustainable? What happens when the market crashes?
That was the next question. Another study simulated withdrawing from portfolios over 30-year periods, including through the Great Depression, the dot-com bust, everything. The finding was powerful. A 4% inflation-adjusted withdrawal rate was highly sustainable. The success rate was over 95%, even in the worst-case historical scenarios.
Actually really reassuring.
It is, though it's worth noting, if your portfolio is very conservative, say mostly bonds, the research suggests you should probably drop that to 3%.
Okay, there's a nuance to that 4% rule that I think confuses people, though. Let's clarify it. Are you taking out 4% of whatever the portfolio is worth each year?
That's the critical question. The classic definition is all about stable income.
Right.
So you take 4% of your initial capital. If you start with 500,000 euros, that's 20,000 euro in year one. Then you adjust that amount for inflation each year after that.
So if inflation is 3%, year 2, you take out 20,600, even if the market just crashed by 20%.
Exactly. Your income stays stable. But the risk, as you pointed out, is that you could deplete your capital too fast if there's a bad crash right after you retire.
The dreaded sequence of returns risk.
That's the one, which is why there's a more prudent variant, the dynamic rule.
Where you take 4% of the current value each year.
Right. This protects your capital way better in a downturn, but your lifestyle becomes unstable. Your income could drop significantly. It's a trade-off. Income stability versus capital preservation.
Okay, let's go back to Sandra's $480,000 goal. That number can feel completely paralyzing when you're starting from scratch.
It can, which is why the sources recommend breaking it down into smaller, more motivating benchmarks.
So that 480,000, that's what we'd call intermediate freedom. It covers everything in her current lifestyle.
But you could start with a more approachable goal. Call it basic freedom.
Just the absolute essentials.
Rent, food, transport, basic bills. For Sandra, that was about $10,800 a year. Times 25. That's target of $270,000 deal. Still a big number, but it feels a lot closer.
And then on the other end, there's the ultimate goal.
Ideal freedom. This is when your investments generate enough to cover your entire current salary.
Meaning you could quit your job and your lifestyle wouldn't change at all. You'd still even have money left over to save.
For Sandra, with her 2,000 euro a month salary, that target is 600,000 euro. Having these different levels, these milestones, is a huge psychological tool.
So once you have a target, the next piece of the puzzle is time. And with long-term goals, time is your biggest ally.
It's the ultimate financial weapon. A long horizon, 5, 10, 20 years, it allows you to take on more risk for more growth because you have time to recover from any downturns.
Which brings us to the price of that growth. Investing, It's not a smooth ride-up, is it?
Not at all. You have to accept turbulence. Howard Marks said it best. Volatility is the price you pay for long-term growth.
And we're not talking about small dips.
No. We're talking about major market crashes, 40, 50, even 60% drops. Your discipline is entirely based on believing the core hypothesis that the market always eventually recovers.
And we have data to support that belief, right? There was a study on S&P 500 corrections, so drops of more than 10%, going all the way back to the 1920s.
And it showed something remarkable. The average returns after a major crash are systematically positive.
How positive?
Just 3 months later, the average return was already almost 3%. And after 2 years, it was up over 14%.
So the key takeaway for a long-term investor is that a crisis is temporary. It's an opportunity, not the end of the world.
It confirms the need for patience, for discipline.
Let's talk about the psychology of that discipline, because seeing a number like 480,000 when you have, say, zero is it's overwhelming.
It is. You have to understand that the path isn't linear. It's exponential.
Because of compounding.
Exactly. There's a saying that the first 100,000 are the most difficult.
Because in the beginning, the only thing growing your portfolio is you.
It's your salary, you're saving, you're doing all the work. But later, the gains start producing their own gains, and the snowball really starts to roll downhill.
So that early phase is the real test. It's a test of motivation, of patience, before you see any of that magical multiplication.
It's the rite of passage. And to pass it, you need to know your fuel. You need to define your capacity for action.
Which is just a simple formula, right?
The simplest. Revenue minus your monthly expenses. That equals your savings capacity.
So for Sandra, it was her 2,000 euro salary minus her $1,400 in expenses.
Giving her a savings capacity of 600 euros per month, that's her fuel. That's her planting money.
And a great takeaway for you, the listener, is this. If that number feels small, the first step isn't always tighten the belt until life is miserable.
No, it's optimization. It's cutting the subscription you forgot about, shopping around for cheaper insurance. It's about not overpaying for the things you already have.
Okay, so we've got the target, we've accepted the volatility, we know our monthly capacity, but we have to talk about the beautiful lies we all see online.
The smooth curves.
Yes. Every investment video shows this perfect straight line going up and to the right, based on a fixed 7% return. It's motivating, but it's totally misleading.
It's misleading because it ignores reality. It ignores crashes, recessions, and most importantly, how we as humans react to them.
Yeah.
Nobody's journey is a straight line.
So what's a more honest way to visualize the future.
The Monte Carlo simulation. It sounds complex, but the idea is simple.
Not a smooth curve.
No. Instead of one perfect outcome, it runs hundreds, even thousands, of potential scenarios based on real historical volatility.
Mm.
It gives you a probability of success, not a guarantee.
I love the analogy they used. It's like if you're planning a 30-year hike,
Right.
a fixed return chart gives you one map that shows perfect weather the whole time.
But a Monte Carlo simulation gives you every possible weather map: sun, rain, blizzards. It forces you to prepare for the worst while you hope for the best.
It's about probability, not prediction.
Exactly. And the results from these simulations are really eye-opening. The example was investing €200 a month for 35 years.
The median outcome, so 50-50 chance of doing better or worse, was around $850,000.
But look at the range. A really favorable scenario, the 90th percentile, got you to almost $2 million.
But an unfavorable one, the 10th percentile, was just under $400,000. That's a huge difference.
It's a massive divergence. And the strategic lesson here is that you can't be rigid. You have to be adaptive.
This is where smart DCA comes in, right? Smart dollar cost averaging.
Right. Standard DCA is just investing the same amount every month, no matter what.
Rain or shine.
Smart DCA says, well, since we know volatility is a given, let's use it. Invest more when prices are low during those bad scenarios, and maybe a little less when things are frothy. You move from predicting to adapting.
And that kind of discipline, the ability to invest more when everyone else is panicking, that comes from understanding this data.
It replaces emotional fear with a logical, prepared strategy.
What's amazing to me is how grounded this all becomes when you replace the wishful thinking with some clear math and a dose of reality.
Financial liberty is built with rigor and patience. It's one grain of sand at a time. I love the metaphor of working versus owning assets.
Shaking the hourglass versus owning the fields.
Exactly. Working is trading your time for grains of value. Owning assets is having fields that passively produce those grains for you. And investing regularly is just planting those fields.
So if you're ready to start charting your own course, the action steps are clear. First, do the work. Calculate your target using that 25x multiplier.
Second, accept the reality of the market. The 4% rule is your guide, and the historical data is your confidence.
And third, be honest about your starting point. Figure out your savings capacity through a real budget and focus on optimizing, not just cutting back.
And of course, the important reminder, these are all estimates. They are powerful benchmarks, but they are not guarantees. Past performance never guarantees future results.
The sources all describe that first phase, the climb to that first 100,000, as the slowest and hardest part. It's the test of motivation where so many people give up. So here's the final thought for you to take away. If this journey is fundamentally nonlinear and demands incredible patience, how might you restructure your life, or maybe just your mindset right now, to make sure you can sustain that discipline during the long, unrewarded test period before the real power of compounding